Everybody, this is Kevin Brinkman, and you're listening to the Brinkman Report. I'm fortunate to have an interest rate expert here today, and this is my favorite topic, talking about interest rates. This is Carol with Derivative Logic, and she is the Wall Street Journal's expert on the subject, and she manages interest rate risk for her clients every day. So thank you for being here today, Carol.
Kevin, thank you for inviting me. Yeah, happy
Oh,
to be here.
good. Well, let's jump right in. So the million-dollar question that everyone is wondering is, what are interest rates going to go and do in the future? Would you mind giving us a feel for how you forecast interest rates?
Yeah.
Mm.
The first place I go, it's really kind of the technical and just looking at the chart and say, hey, what story is this chart telling me?
And is
You
that
know,
the
are
same
we,
thing I've heard of, like trend following or trading momentum? Is that type of like kind of the same thing?
yeah, it's very
Okay.
similar. Yeah, very similar. And
Okay.
now bond market, watching the bond market trade, it's basically like watching paint dry.
Mhm.
So I started out kind of learning technical when I was trading equity options. And equity options, if you day trading, you couldn't press the button fast enough. Okay. Like once you place the trade, you sit there, you're not going anywhere. Bond market, they move slower. And these days is a lot of the news driven. So technical is the first place I go. I wanted to know, okay, what is the chart telling me? Where has this been? Where does it look like it's going? Because
Got
unless there's like strong conviction for me to say, okay, I think that, we're going to break trend here because of some event, then we have a story to tell. Otherwise, for me, it's like, okay, there's a trend. I just try to get to the bottom of the trend when I call my client.
Gotcha.
So that's one
So
thing.
step one, you pull up your chart on Bloomberg and you look at the trends and kind of big picture. Okay. And then
Yeah.
what's step two that you usually do?
So step two, they might be, just, they could be different, but the chart is easy for me to pick. Second is like, okay, what are the macroeconomics data that I'm interested in and that the market is interested in at this point in time? So two big topic, right? One is um, employment,
Mhm.
and then two is inflation, right? So they basically are two two forces that's kind of getting us to where we are. So let's kind of go through the employment number really quickly. Non-farm payroll. Last year, basically every month, we have blockbuster numbers, right?
Yeah.
And the market was like, wow, look, like economy has gotten so strong, even though we raised interest rates so much, and it hasn't really caused any slowdown in employment. Well, that's great headline. Now, I also follow headlines because headline move the market, right?
Hmm.
Even though maybe like under the surface, the number really isn't that great. I'll give you some examples. So headline numbers look good. For non-farm payroll, they basically have 2 months to revise those numbers. So after the initial number, getting pushed out, every month there's revision for 2 months. So those revisions actually weren't being announced. And pretty much last year, these revisions are all revising down, most of them.
Hmm.
So that tells me, okay, the underlying um, employment number really isn't that great, but the headline shows it's great anyways, which I care about because that moves the market.
Gotcha.
Um,
So the headline is what's the most impactful to
yeah,
move the yields more
yeah,
than the
it is.
actual underlying data. Gotcha. Okay.
That's where things are right now. I'm not saying this is forever, right?
Yeah.
Because from what I see in the market, Wall Street is actually catching on. I have economics, chief economists, or chief interest rate strategists coming out from big Wall Street shops and say, hey, this employment number looked a little inflated. Like they're catching on and realizing, okay, the headlines are good, but really, if you look under the hood, maybe it's not as good as it seems.
Yeah.
So
Yeah.
I think Wall Street is catching on, and I think that we are going to come to realize the employment situation is far worse than what the headlines say. So market and people are going to adjust to it, right?
Yeah.
So worse employment number means what? Market is going to say, hey, you better cut rate more
Hmm.
aggressively, right? So that's that's what I'm waiting for, right? I know, when the news come out and say, hey, look at these data, like more people saying, hey, this number is not as good, then we
Yeah.
we're gonna have more cuts. So that's kind of what I look at. Same thing with unemployment number.
Yeah.
Unemployment number, it hasn't changed forever, and you scratch your head, you're like, how is that possible? All these tech layoff, and where has these people gone? That make no sense, right? And
Yep.
now, you have the funny thing of, okay, now recently our unemployment number have gone up, but our employment number also have gone up. How is it even possible?
Hmm. Yep.
Like,
Yep.
it's a mixed bag of like information. How do you dissect that? What's real, what's not real, and how's the market responding to it, and how will the market respond to it?
Gotcha. So let me jump in with some specific questions. Um, how much are all these the different events from unemployment coming out to geopolitical risks? How much of that is priced in to the pricing and to the yields already? And how do you determine that?
Yeah, that's even more specific. Um, I think it is
Hmm.
priced in to some extent from a volatility standpoint. So bond volatility has been staying high for the past year until now, and it'll continue to stay high. So we have higher bond volatility. Does that mean everything is baked in? Absolutely not, right? The goal of kind of the financial market or power to be is to not create fear. So whatever it takes to keep things calm, they would do, right? So definitely not baked in. Now, in terms of like, hey, what percentage do you allocate to geopolitical risk? What percentage do you allocate to the national debt? What percentage do you allocate to the unemployment number? That changes every day because market is super reactive and market likes to overreact, at
Hmm.
least for now. Loves
Yeah.
to overreact. Overreacting is good for my clients,
Yeah.
right? Because if bond is going down 15 basis point for whatever silly reason, silly headlines in the market, I'm calling my clients,
Yep.
right? Now, if it reacts the other way, it overreacts the other way, I'm like, okay, let me just wait a little bit because it's going to come back to its senses.
Yep.
So, I take
And so
advantage
and
of.
and so what do you think? So let's just pick the 7 year. And I think the listener here is really interested in multifamily. And most of that, we're using the 5, 7, or 10-year treasury as the index, usually with an agency loan from Freddie or Fannie. So a lot of interest in what treasuries are going to do. What's your forecast for the next 6 to 18 months?
Yeah, for where 7 year treasury will
Yeah, let's
be.
just say 7 year. Yeah.
Yeah. Um, I think the outlier factor here is actually Japanese yen.
Okay.
So, and I know you want just a straight answer. It's hard to, I know it's incredibly difficult to get a straight answer.
Yeah.
So yen is basically depreciating in values. I don't know if you've seen the chart or the value today, but
Yeah.
I think it's like 1 USD to 160. Uh, Japan is the largest bondholder of US government debt or foreign bondholder of US government debt. For them to defend their currency, they will have to sell massive amount of US treasuries. Now, these US treasuries are long dated US
Okay.
treasuries. So it will affect the longer end of the curve. When you have massive supply of treasuries, yield is going to go up, right? If you don't have enough buyers.
Yeah.
So that's kind of the undercurrent. Now, timing wise, I don't know. I don't know if Bank of Japan is going to try to defend the currency. I don't know what they're going to do.
Mhm.
But that's kind of one thing. Now, going back to your question, where will 7 year treasury be 6 to 18 months from now? That's a huge range. I would say 6 months, like between now and 6 months from now, the 7 year treasury should probably go down
Yeah.
because the market will come to realize the labor market condition isn't necessarily as good as the headlines have has presented to. So I think market's gonna force the Fed's hand to cut rates more because right now the Fed say, hey, we're gonna cut rates one time in 2024, but the market's still baked in two. So I think the market is going to force Fed's hand to cut even more.
So on that topic, I just looked at the debt clock for the U.S. is just under 35 trillion. So
Yeah.
does the amount of debt and the amount of treasuries that the U.S. needs to auction hugely impact the yield over time, just from a supply and demand point of view?
Absolutely. If you look at the U.S. debt chart, the U.S. debt has actually grown exponentially since COVID.
Yeah.
It's like vertical,
Totally. Yeah.
Yeah, it's like vertical. And so think about it, like when they issue debt, if nobody is buying it, what are we going to do? We put in more money to buy our own debt.
Yeah.
Right. So, you're creating more money supply doing that. And so that's a huge problem because whatever me and you do isn't going to stop that from tapering.
Mm-hmm.
So, yeah, like it's a huge problem. And, and think about it. This is what I think about pretty regularly. Like our children, like my kid and your children, they
Mm-hmm.
are born into this large debt that our government has. How fair is it? Like, it's like we pushing the liability down the line.
Yeah. Yeah.
And so that to me, it's a big problem. Now, is it easy to solve? No, because there are all these people, we can buy vote by providing more benefit to voters, right?
Mm-hmm.
Nobody wants to cut benefit if you go out and say, hey, we got to cut Social Security.
Yeah.
people gonna like protest, So
Mm-hmm.
it's not easy, and I really think it's a big problem. I saw that coming during COVID.
Yeah.
The train left the station. What are we going to do? What do you think, Kevin?
I think short term, I think yields are going to come down. And I agree that from employment, that's going to get softer. I think our GDP growth will, I don't know if we'll go into recession, but it'll get pretty close to zero. And I think the Fed will cut interest rates. And that's what's kind of interesting. On the short end, you have, Fed funds rate and you have SOFR, which a lot of our, bank loans are on. But then on Freddie and Fannie, the longer term debt is more on treasuries. And I think those are two totally different things. And the question I have for you is, when I'm talking to clients and they say, well, I think the Fed funds rate is going to be higher for not longer, but forever. I always think, well, when we go into a recession, if it's a year, 3 years, 5 years, 7 years, the Fed's going to reduce the Fed funds rate, right? So is there a scenario where when we go through a recession that the Fed funds rate doesn't come down? It would be like a stagflation type of thing, but I think that would only be like on the supply side with the issues causing inflation. But if we have negative GDP growth, I think the Fed's going to reduce interest rates to create some demand, right?
There's no always for certain. I think if you look at, I think it was World War II, where we had like what 80% interest rate, but we
Yeah.
were like going through depression, so a
Yeah.
high rate, and the rate stay high for a long time.
Yeah. Yeah. Yeah.
We can definitely be in stagflation because society is changing, right? Like the old rules don't apply anymore. The basic concept of what we learned in economics and finance from the books, those are all out the door at this point.
Mhm.
The system we have, it's not really a resemblance of kind of the old structure. There are all these different players who have gotten themselves in position where they can manipulate the market.
Like, what are those entities that
Now,
manipulate the market?
I'll give you one example in the equity space. If you think about, We think about stock prices as a matter of demand and supply. Like you want to buy Microsoft and you go buy it and you own the shares and someone wants to sell you at that price. Pretty straight and simple, right?
Hmm.
But look at how the equity market has changed. Now everybody loves what? They love index fund,
Yeah.
right? Index fund ETFs and stuff. And guess what? Now the index funds are the one that actually moves the market. There's no price discovery anymore. Now, on top of the index, because there's not enough actual buyer and sellers, they're all indexing to something,
Hmm.
right? So they're just reallocating. We reweighted their index, either daily or monthly or whatever. So who's discovering prices? There's no actual buyer and seller. There's just like
Yeah.
massive funds who are just indexing. On top of that, you have people who have large equity swap positions, right? So for large equity swap positions, you have traders who need to delta hedge. And so now you have created this like fictitious demand or demand for shares for hedging purposes. Now you created sort of a demand that wasn't there before we have these large equity swaps. And then add to it, you have short sellers whom I hate.
Hmm.
Okay. I think it should be illegal to short stocks. You have large funds. Oh, yeah. I don't think I'll ever get a job with them. Um, you have large short sellers who are um, borrowing shares and then putting these shares out as if they're real shares. Now you've inflated supply of these shares of stocks. It's like there's no price discoveries anymore. Like that's
Yeah.
just one example. Same with like the bond market, like the treasury. Like the yen situation. They have to sell treasury to save the yen. There's no
Yeah.
demand. It's a policy issue. It's not a real actual market demand and supply.
Yeah. So let's see if where do we differ? So I think short term we both agree that the economy, the U.S. economy, is slowing, and that will impact employment. So the Fed will lower rates, sometime this year, but into next year. And then the question is, into what point? So it's kind of that neutral rate. If we're in the high fives now, I feel like they're going to go to at least to the mid to low fours. Do you agree with that?
That's what the 7 year you're looking at.
No, I'm saying Fed funds rate.
Oh, sorry, Fed fund.
Yeah,
What time frame?
I'd say by the end of next year.
I think that's possible. And I think for me, it's mostly the forward curve that matters to me more than what the Fed actually do. Because a lot of my client, when they need to trade, their pricing, it's based off the forward curve.
Would you
So
take a
if there's
quick minute and just explain what the forward curve is for the listeners?
Yes. So basically, the forward curve is an aggregate or, a curve that shows sort of market sentiment as to where Fed fund could be or
Mm.
SOFR could be. So that's basically an aggregate of, people trading futures in SOFR, people trading um, swaps in the SOFR swap market, aggregating them and say, hey, what does that mean in terms of future price of SOFR, which SOFR and Fed Fund basically, move in tandem at this point. That's what the forward curve is. Now, it's always wrong,
Hmm.
and which is fine,
But it's
right?
what
Because
the market believes interest rates are going to be in the future, right? Which is kind of the best information we have.
yeah, it's the best information we have, and it's what we trade on. Like the
Yeah.
for anyone that buy like lock into swaps or lock into caps, the forward curve is the price they pay. So the
Yeah.
lower the forward curve is, the better the pricing it is. What will become real, like what will the realized SOFR rate will be, that's a different story. And if there's a large gap between what the forward curve is and what we think the actual rates will be, that's kind of where the gold mine is, right? Because
Mm.
for me, if I were to be running a hedge funds, I'm looking at that gap every day because that's where I can make my money.
Yep, yep, yep. So the interest rate curve is inverted right now, meaning the short end is higher than the long end, right? So how does that end being inverted in your mind? Does the short end need to come down? Does the long end got to go up, which isn't great for real estate? Or is it a little combination of both?
I really think it's probably definitely, the short end has to go down. That is,
Yeah.
um, but when I say definitely, if you look at the probability of kind of what market expectations are, there's actually some kind of probability allocated to rate going higher. So just to let everybody know, that there is a market, somewhat of a market sentiment that rate could go higher. You
Okay.
know, and then for the longer end, I think that longer term probably will come up a little bit.
Yeah. Yeah. Yeah.
Yeah. Yeah.
And then, so with all the complexity you've talked about on kind of the trends to even capital coming out of Japan, it seems so hard to forecast. One thing I've thought about is just, all the big banks have PhD economists who study this and have their forecasts. Do you think for a practitioner like us, it could be a decent idea just to take the top 5, 10 forecasts from the big banks and just put a median or an average on them? Is that another way of looking at it potentially?
I like the idea of it. Actually, if that's what you feel comfortable doing, you can absolutely do that. And I
Okay.
would say 90% of the time, these big banks are wrong.
Yeah.
If
Yeah.
if you look at the equity analysts, that do buy side equity, sometimes I wonder why they have jobs because they're always wrong,
Yeah.
right?
Yeah.
Like
Yeah.
if they're not putting their own money into some, the trades, then they can say whatever they want and get paid, right? So, you kind of want to figure out like who got skin in the game
Yeah.
because
Yeah.
those people will be the one that really care to be right. Well, who are these people? Like traders, trading desk traders? They don't publish anything, right? The traders don't, they're just there to make money.
Yeah.
And so like once in a while I talk to traders and kind of see where, what they think where things are. Hedge fund managers, like I like hedge fund managers. Again, they're putting money where the mouth is, right? They're
Mhm.
putting bets in the market to make money, right?
And so that's another thing that you do is that you'll just call straight to these traders, straight to the hedge fund managers who have skin in the game to understand like what their predictions are and where they think the trend is going. Is that right?
Yeah, so those are the two menus. And, I have to tell you, I started posting on LinkedIn a year and a half ago. That has yielded so much
Hmm.
knowledge, tremendously. I have friends on LinkedIn who, run hedge funds, and they talk
Yeah.
about, what they're looking at. Now, does that mean they're always right? No, you're right, because I can have a different view. Nobody's always right? Because otherwise, we're not human.
Yeah.
Um, and so for me, it's about digesting information from like sources that I feel are credible and people that dissect kind of all these details for me that I can see, okay, this is what the headline says, but this is really what it's underlying. And then just have, interact with people. The more you interact with good people, the more good people you find to interact with.
Yep. 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 So could you talk a little bit about what a hedge is and how you apply it at derivative logic for real estate?
Yeah. So for the ones that are not familiar with ever, for hedging, if somebody has a floating rate debt, they would want it to buy some kind of insurance so that they know where the maximum interest rate would be. And that means they would, buy potentially interest rate cap where they pay a premium. And then if interest rate go up beyond a certain coverage, then, whoever they purchase the insurance from will pay the difference. So, you kind of have like, an idea as to what your worst case scenario is. That's one simple vehicle, but there's like there's swaption, there's quarter, there's collar, there's floor, there are all these different vehicles. One category is option product, the other category is like credit product, where it requires underwriting on the of the derivative.
Yeah. Yeah. So in reality, people just need to call you when they're trying to manage their interest rate risk. They could reach out to you as a resource. The see what different strategies there are to do that, right?
Yeah, they really should. And I know I always encourage people to just call me, even like, when do they want to lock in their fixed rate, or like if they
Yeah.
have a floating rate, whatever. Because you guys are really good at managing properties,
Yeah.
right? And like the operational side of things, the finance side of things, the property location, the tenant, or whatever. And there's a lot to look at in the interest rate side. And most commercial real estate clients, they just really don't have a specialist at their desk who look at this stuff all day, every day.
Yeah. All right, Carol, we're going to end with a speed round. So you're going to just give me a number. So what will the 10-year Treasury be by the end of 2025? What will the yield be?
4%.
Around 4. How about what month do you think the Federal Reserve will start rate cutting?
Cutting between now and September.
Now in September. All right. And then do you think the economy is in for a soft landing, hard landing, or no landing?
Hard landing.
Hard landing. And when do you think we'll start having that negative GDP growth numbers kind of hitting?
I would say last quarter of 2024.
24. Okay. Awesome. Well, we'll leave Carol's contact information in the show notes. So please, anyone who's trying to manage interest rates, feel free to reach out to her directly. And thanks for listening. We look forward to seeing you again next month.